leave this tax rate in place for another year, maybe two. It also proposed waiving payment by states of the interest that they owe on their debt, and that's in the 1 to 2 year range. All this is still subject to negotiation in Congress. Lastly, it proposed increasing the federal wage base from $7,000 to $15,000. And the law is that every state must at least match the federal wage base. So we're at 12, so if Congress was to do that, then our wage base would go up $3,000. I don't know that we can give you any tea leaves on what they might or might not do.
What did you say that the increase would be after 112?
And the future rate is 0.3, and then 0.3 every year until you're out of debt.
Kenny, how does increasing the FUTA tax help the Arkansas Trust Fund? That money's going to the feds.
That money goes to pay against the balance.
Okay.
That's what
Automatically charged to them.
Yeah, that's what it's designed to do. When they created the system for it to be paid for by employers, they anticipated the loans and the debt, and this was the design to get it back to the states wouldn't have to do.
To be real clear, nothing has to be done for all this to take place.
Yes.
All of this is on autopilot. It's baked in, and it's happening now.
On schedule to happen. Now, we'll give you a little bit of history. The Arkansas Trust Fund balance, which is currently $360 million in debt. Over the years, that advisory council that I mentioned earlier had a goal. We wanted to try to keep that in the $200 to $300 million balance range. But honestly, looking back at the past 50 years of balances, I think the high water mark was about $275 million. As you can see, in 03, we were a little over 100, and it started trending down. Legislation was passed to raise the wage base in, I believe, 03. As you can see, that had a positive impact. It drove the trust fund balance up. Then we started seeing early signs of the economy declining in late 07, and we started discussions about whether another wage base increase was needed. I say that the $12,000 is the wage base, and that had been the history of how to address downturns. That had been, look back over about a 50-year history. Whenever the trust fund needed money, the response was usually increases in the wage base. But then the economy tanked in late 04 and drove the trust fund deep into debt. And here's the little brief wage-based history. I couldn't figure out how to get 50 years on one slide. It started at about $3,000 in the 20s and 30s. Made a few jumps, but basically it stayed fairly stable. We were talking about two $500 increases in the wage base in the early days of the 09 session, and then we got the fourth quarter from 08 numbers and saw, Lord, we are tanked bad, and so the $2,000 wage base was put in. This is just a little background. It's obvious. This is the total uninsured rate for the past 4 or 5 years, and as you can see, the economy in 08, 09, and 10 has been about as bad as we've seen in our lifetime. Now, our debt in Arkansas is not unusual. In fact, right now today, there's 32 states plus the Virgin Islands that are also in debt like Arkansas is. The total combined debt nationwide is $48 million and growing. Billion dollars.
Trillions are listening.
They are listening.
They got to pay.
$48 billion. And there's 11 or 12 states that are in the billion-dollar club. California's the leader. They're right around $10 billion in debt. Is it up? $12 billion. It's hard to read that report every Monday. It's depressing. So I didn't read it Monday. And again, our balance is $360 billion. All right, now, knowing all of this, and we've been trying to warn the business community about this for at least 2 years, we went into the legislative session thinking something had to be done. Our strongest desire was to see the benefits side of the program be cut, obviously. Otherwise, the only other thing you can do is raise the cost side on employers. Unfortunately, won't get into a lot of the details, but some of the things that came out of Washington during the height of the recession put limits on how you could cut benefits. So we looked at a list of items that we thought would save the system money without violating the federal guidelines. Because basically, if it violated the federal guidelines, a lot of the extended benefits Randy was talking about are paid by the federal government. They'd stop paying them, and our problem would just get much worse quickly. So with the help of a lot of good legislators, we passed what's now Act 861. And I'm not going to go into the details of it, but just know a few things. Number one, it's going to save the business community between $60 and $70 million a year. And the big highlight is that we eliminated what has been called the indexing of the minimum and maximum benefit. In the late 60s, there was a big battle that we lost. The legislature passed this indexing, and so that minimum and maximum went up every year. And what it did, it drove our average benefit amounts to be the highest or the second highest in our 7-state region. Very costly. This is going to save alone about $16 million a year. The other thing we did is we reduced, the state only pays the first 26 weeks, and the feds pick up after that up to about 98 or 99. We went and included in our bill a reduction from 26 to 25. Now, I noticed Michigan about the same time reduced theirs from 26 to 20. Florida did too. We chose 1 week for political reasons. The numbers we got out of DWS said this would save about $5 or $6 million. The second week would save about $500,000. And we knew every week we tried to cut would make the political battle that much tougher. So we thought $5 or $6 million was a pretty good chunk. 1 week would be a lot easier politically to try to pass. So that's what we put in the bill. In 2009, the bill we passed that had the wage-based increase in it did an equalization of how people are treated, whether they quit or whether they're discharged. That has about a $20 million savings factor to the system. It had a sunset clause on it at the end of this year. That's now been extended to 2 more years. And then the part that I can't explain, we did a lot of things on eligibility. The most significant one that will save about $25 million is something called qualifying and requalifying wages. We increased the time period up to 35 weeks and needing to earn wages over 2 quarters. I've never filed an unemployment insurance tax return. I ain't got a clue what that means, but I bet every one of you in the room does. So somebody explain it to me before you go home. But again, $60 to $70 million in savings. It had a dramatic impact on the numbers that Randy's about to describe. Now, the other bill, and the reason we're here, was the other bill that was passed is now Act 1125, puts in position for an adjutant, Gene's here, to prepare a report for the governor. And then the governor has the authority, if he so chooses, to call a statewide election. And in that election, the voters would have the authority to authorize the state to issue up to $500 million in revenue bonds, and included in there is an assessment on employers to provide a revenue stream to pay back those bonds. And that assessment would begin the first of the next quarter after the election. Now, there's interest accrued already and due in October or November. But one of the factors in this election decision is you have to, if you pay off, it's about $10 or $11 million by the end of September. Or actually, if you pay off your debt by the end of September, you don't owe the interest. And then when you factor in the time it takes to issue and sell the bonds, 30 days to certify the election, you start backing up, you need an election in August. The governor needs to make this decision probably by June 1. So that's why we're out here right now in May talking about this. And at this point,
in the final version of that bill, who determines the assessment